This is our Forex blog for May 2nd, 2012, and like most days, we buy the strongest currency versus the weak and sell the weakest versus the strong. This is our build your own trend currency meter, which allows you to set the variables however you want with whatever weights that you want. Most of the tools measure the percentage of, in this case, dollar pairs going up or down versus all the rest, and the bottom two measure the intensity of those trends. So when, let's say, 80 to 100% of dollar pairs are going up, and they're doing so with incredible intensity, you will see green levels at and above the 80 level. Underneath the real-time strength, we have the percentage of currencies trending up and down on the 15-minute chart, and then hourly, daily, weekly, and monthly. You don't have to have them all line up, but it definitely adds to your probability. You definitely want to see real-time strength today, and ideally strength on the 15 and hourly trend and the daily. And the weekly also helps. I don't really care myself whatsoever what the monthly trend is. However, if it is dark red and you see some strength coming in, you're likely to make less pips by buying that currency if the monthly trend is super weak. That's all. You can see that New Zealand today, for instance, had brief amounts of strength. The daily or the 15 and hourly trend was mostly down, but not too much. Daily trend shifted up, but the weekly monthly were very weak, and some intense weakness came back in around 8, and it lasted until right now. So that's what typically happens. The more time frames that line up, the more likely the trend and the trade you take with them is to work, and the more likely it is to stay moving for a long distance, which allows you to make more pips when you're right. And that's the key. Small losses, bigger wins. So today it's pretty clear that the dollar was one of the stronger ones. The yen started to show some strength, and the 15-minute trend shifted very strong up here around 347. So basically you want to sell the euro dollar and sell the euro yen. The Swiss also is extremely weak, which means you want to sell the Swiss yen and buy the dollar Swiss. So let's start with the euro dollar. We obviously knew we wanted to sell this. It's kind of going sideways right here. You might have sold right here with a small loss, 5 or 6 pips. Shorted again here when it broke down at 17. Notice our trailing stop got you out right here at 81, almost a 40 pip move. You also would be best served by using our range charts instead. This one had you short right. This one had you short right here at 18 and out at 75. So it made an extra 6 pips. And then if you wanted to sell down here, you can see you're short there, small loss, short again here at 61, where you got out at 45. Here's the euro yen. This one also we're looking to sell, especially after, I think, 330. And it was above the hourly. When it's above the hourly, it's more likely to go up. You can see it hit my Fibonacci profit target level. I do these each night so you don't have to. I do it for my own trading. It's also part of my automated systems that I trade for my own accounts. These are key areas where I expect major buying and selling. If the price is coming up to it from underneath, there's likely to be selling there. If it comes down to a Fibonacci area, there is expected to be major buying, and it's a good place to get out of your trades. But if you missed this first entry here at my fib level, because it was strong earlier in the day, the real-time trend was up, the daily, the weekly and monthly were down. And that's why we look at all the time frames. You can usually get away with selling currencies up at the high once the strength falls away, like right here. And if it breaks down, it's likely to come down to the previous day's high, previous week's low, or the hourly. If the trend's going to continue up, it's going to find support no lower than the hourly and then bounce off of it. The fact that it shot through there means the trend's likely to go down. So you could, do some quick scalps and make 20 pips here. You would have lost, actually you're short here at 77. Probably after the spread, lost 3 pips here, shorted here at 75, out at 59 for about a 16 pip win. Also, the Swiss, one of the higher probability ones to trade against the strong dollar. You want to buy the dollar Swiss. And let's bring up a 6 pips per bar range chart of the dollar Swiss here. And these are Fibonacci areas I expected to be have likely buying in the market. Shot through the first one, it ended up hitting the second fib target, and that's where the major resistance ended. Our containment bands, the 3.0 containment band, about 95% of the time is the highest or lowest price will go. If you click on this, you can see The 3.0 containment band I like to color green. That is usually the maximum high it's going to go up. So it's a great place to exit with profit. These are all statistically based on the highest volatility over the last 20 days, projected around the hourly moving average. So, you know, it's possible, although very unlikely, that today's volatility is going to, you know, go explosively through these bands. But most of the time, you're going to find that price is contained within, you know, the red 1.5 and the white 2.0 band, but it virtually never stays above this 3.0 band. In fact, I oftentimes look to sell up there. This is where I put in big counter trend trades, you know, when these levels get hit. Now, ideally, if you're going to do counter trend trades up here at the high above the 3.0 green band, ideally you want the weekly and also the monthly trend to be down. And so today would be just a counter trend move up, but the weekly and monthly trend is down, so you have a lot of people selling the highs or exiting profits at the highs because they know they're not in a long-term uptrend. They're going against the longer-term trend, which is down. In this case, all the time frame trends are up, and we're up around 330. But you can see our intelligent trailing stops got you in here at 85 and out up here at 41. Excellent 55 pip profit on that one. And I will end today's blog post doing the Swiss yen. You can see it pretty much trending down all day. This is not one that we normally watch, and it's best to trade it with a range chart. But this is just a 5-minute chart using our 5-minute trailing stops. Had you in short at 53, out at 60, or I'm sorry, out at 86. Looks like you got short again at 79, and it's hard to tell with the colors on here where it got hit, but it's more than likely out somewhere around here because that's where it actually got out somewhere right here. That's where it flipped. You can see the green trailing stop started, so probably got out somewhere around 60 on that second trade. Short at 82 for a nice 22 pip win. Now, a lot of new traders think, I don't want to just catch 10 and 20 pip moves, but the fact of the matter is you can make a lot of money trading if you net 10 pips per day. That's all you need. 10 pips per day doubles your account every 2 months. So only a fool would have a problem with making 10 pips per day. 10 pips per day, starting, let's just say, with a $2,000 account, you're trading a very small number of lots. At the end of 8 weeks, approximately 2 months, you got almost double the money. You can see it's doubled again, and obviously the power of compounding comes into play here, but your account at the end of the year is an astronomical 258,000. So 10 pips per day, or even a 20 pip win like this, that's 2 days worth of minimum profits. You know, have reasonable goals, 10 to 20 pips a day. You're going to have losing trades. Some of the trades are going to lose 3 to 8 pips, but keep your losses always under 10 pips, 12 at the max. During more volatile times, that like we've had a few months ago with currencies moving a lot more than they do right now, you could have 15 pip maximum losses when in pairs like pound yen.